Hi, this is part 5 of a 6-part presentation on great. Now you have $100,000 to invest. What are your options? In the previous videos, we looked at how you can use financial analysis to implement an investment portfolio. Then I discussed Sector Surfer and how it can be very useful in following timing advice and setting up timing portfolios. Very sophisticated website. Then I discussed how to use moving averages to implement simple portfolios yet with very low risk. In this video, I will talk about dual momentum. Then in video number 6, we'll talk about macro strategy. The original idea of dual momentum was proposed by Gary Antonacci, and in a paper that is readily available on the internet and in Seeking Alpha. His system was based on the choice of U.S. equities, international equities, real estate, gold, and bonds. In this presentation, I propose a slight variation which appeals probably for people that are a little more careful in implementing his model, because his model really was based on investing on the best of the alternatives. What I changed it into is to invest into a packet of best investments. Let me show you how. The original dual momentum model is very simple, and is basically saying that you have to compute the 12-month rate of change of all the ETF that you are considering as an investment. If the rate of change is greater than the yield on the short-term treasury bonds, which is shy, then that particular ETF should be considered as an investment. To be considered as an investment, as I said, the ETF must have a 12-month rate of change greater than the yield on shy. And invest in the ETF with the highest rate of change. The way I modified this model is, as I said in the previous slide, is to invest in a packet of ETFs with the highest rate of change. Let me show you how I do it. The major findings behind the value of the research done by Antonacci is that price momentum is a valid investment factor. In other words, if price has been rising, the odds are that that price will continue to rise. If price is declining, the odds are that the price will continue to decline. This is particularly true if the price momentum is computed over a 200 days. And this momentum can be used successfully by investors in setting up their portfolios. A friend of mine, who I will call Chuck, and we discussed at length the dual momentum strategy, and each one of us came out with their own approach, which really is very similar. The way I do it is this. I take the 12 S&P 500 sectors, the spiders. At month end, I invest in equal amount of money in the ones ETF with the greatest 200-day rate of change, if, of course, the rate of change is greater than the yield on the 90-day Treasury bill. Now, investing in the best, in my book, is too risky for my taste. Therefore, I take a group of ETF, maybe the 3 or 4 best ETF in terms of rate of change, and then I invest an equal amount at month end. The decision is made only at month end. For those of you who follow me on Twitter, I tweet many times this chart during the 2018 slowdown. At that time there was an economic slowdown that lasted throughout the year, and what you saw is again a typical example of what Antonacci found. It is that the change over 12 months tends to persist. And what this chart is showing is a change over 200 days of the 12 sectors of the S&P 500. And all throughout the year, when I showed this chart, what were the best 4 sectors? There were staples, there were healthcare, there were REITs, and there were utilities. These 4 sectors were constantly the best ones. So that's why momentum works. Why does momentum work? Because during 2018, the economy slowed down, and during that time, when the economy slows down, these are the sectors you should be invested in. I prepared many videos on the subject of business cycle and sector performance. So this is a classic example of why persistence of momentum really works, because again, is caused above all by trends in the business cycle. Well, let me say that again. Momentum is a reliable money-making force. And why? Because asset prices are driven by the direction of the growth of the economy. If the economy strengthens, you should be in cyclical stocks. If the economy slows down, you should be mainly in defensive stocks. But the system, the model that I'm discussing in this video will help you automatically invest in the right ETFs. At the end of each month, I prepare the following charts, and I'm using them to find the most attractive ETFs. I use 3 indicators, and they are readily available using the charts of stockcharts.com, which you can draw free. They're free. The first one is I draw the chart of the ETF and the 200-day moving average. Then the second indicator is the rate of change of the ETF over 200-day, and then its 200-day moving average. Then I also compute the relative strength of the ETF divided by SPY. This ratio is important because it tells you if the ratio rises, means that ETF is rising faster than the S&P 500. If the ratio declines, that means that this ETF underperforms SPY. So really, intuitively, should not be considered if underperforms SPY. So this ratio is used to compute the strength of the ETF compared to the market. And is also, I compute the 200-day moving average. So let me show you how the chart looks like. This is the typical chart that I use to see which sectors are attractive using the dual momentum strategy. You see 3 graphs. The first one is the price, the green line of staples. XLP is the ETF, and this is the 200-day moving average, and focus on the trend of the 200-day moving average. This is the rate of change of XLP over 200 days. Again, this is the dual momentum strategy to focus on the 200-day, and this is the number that I will be using later. This is the 150-day moving average of the rate of change, and it gives you an idea of the momentum of the strength of the price of XLP. Clearly here the momentum is up. In this case, the momentum was weak on the increase of the price. This is the ratio of XLP relative to the SPY, that is relative to the S&P 500. When the ratio rises, it means that XLP is rising faster than SPY. When the ratio declines, means that SPY is appreciating faster than XLP. And this is, again, since 2018, the opposite happens. The price of XLP increased faster than the S&P 500. That's why the ratio is rising. This is the 200-day moving average to see what is the momentum of the relative strength. Now, this is an important ratio, by the way, which I will be using later in another strategy. And notice how the strength of the relative strength the trend is up for a long time. The trend declines for a long time. This is already more than a year. Why? Because during this period, the economy is weak. Here, the economy strengthens, and here, the economy is weak again. In other words, this is what I've been saying. The the strength, the momentum works because it reflects economic business cycles. This is the chart of XLU, the utility sector of the S&P 500. And again, the chart is divided in three parts: the price with the 200-day moving average, the rate of change with the 150-day moving average, and this is the rate of change number that I will be using later. And this is the relative strength, where the utilities here are fairly strong, then they weaken, and then they strengthen again. The relative strength, which is the ratio between utilities and the S&P 500, is very similar to what we discussed in for the XLP, the staples sector. This is the real estate sector of the S&P 500. Again, same chart, in three parts. This is the price, the green line. This is the 200-day moving average of the price. This is the rate of change, the green line over 200 days. And this is the 150-day moving average of the rate of change. Clearly, there is a strong momentum here. This is the relative strength of the real estate relative to the S&P 500. Again, this is the daily ratio, and this is the moving average, the 200-day moving average of the ratio. Notice again, it's very similar to that of staples and utilities. The ratio rises for a long time during periods of economic weakness. It goes down during periods of economic strength, and then the ratio rises again, showing that the real estate sector is appreciating faster than the market during periods of slower economic growth. Again, this is the number here of the rate of change at this point is what I will use later to establish which sector are most attractive according to the dual momentum definition. This is an example of the chart of the energy sector of the S&P 500. This is the price, the green line, and this is the 200-day moving average of the price. Clearly, is not positive. Actually, it's quite negative, going down. This is the the rate of change of the price. There's the green line over 200-day, and the blue line is the 150-day moving average of the rate of change. So you see here that the rate of change is negative, and notice how the momentum of the rate of change is coming down, exactly the opposite of what we saw for utilities and staples and real estate. So that tells you an idea of which sectors are going to be more or less attractive. Again, what the numbers that we'll be using is the relative change here, that over 200-day. This is the ratio of energy relative to the S&P 500. So it's a ratio of energy sector relative divided by the S&P 500. This is the daily computation, and this is the blue line is the 200-day moving average. And clearly, what it shows is the relative strength. The sector is really underperforming the market quite heavily, with the momentum really heading down. This is the chart of the materials sector of the S&P 500. Again, this is the price of XLB, the daily price, and this is the 200-day moving average of the price. This is the rate of change of XLB, the over 200 days, and the green line, and this is the moving average, 150-day moving average of the rate of change. And you can see now that there is some momentum up on the price, on the rate of change. And again, this is the number, which is a positive number for the rate of change. This is the ratio of between the XLB ratio XLB divided by the S&P 500. This is the daily computation, and the 200-day moving average declines quite sharply, and that tells you that during this period materials have underperformed the market. Remember with the chart of staples, instead the chart of staples was going up, which was stronger than the market. So this momentum here of underperformance is quite strong. Okay, let's see now how do we use the information that we have on those charts to determine which sectors we should be investing in. Again, remember, this is a computation that is done at month end. Now, if you do it on month end, when I was looking at these charts, this is what the data, these are the sectors. This is the ratio of ETF and SPY. This gives you the relative strength of the sector. And if it is greater than the 200-day moving average, this tells you that there is a strong momentum. Then in order to improve on that, if you take the ratio, and if it is greater than the 200-day moving average and the blue line is rising, that's even better. This is the ETF 200-day moving average, and if it's rising. This is whether the ETF is greater than the 200-day moving average. And this is finally the ETF moving average of the rate of change if it is rising. And this is the actual rate of change. So let's take, for instance, the sector that we just looked, what was it? XLP, staples. Well, what you saw, if you go back to the chart, is that the ETF, the relative strength, the green line, is greater than the 200-day moving average. The ETF, the relative strength, has the moving average, the blue line, rising. So that tells you there is even stronger momentum. Now, the moving average, the 200-day moving average of the price of the ETF is rising. So that tells you that the price momentum is strong. Not only that, but the price is greater than the 200-day moving average. So that is even better. And then the ETF rate of change, the moving average, is rising. So that tells you that the rate of change is actually, the price is accelerating. What is the rate of change? The green line value that I told you I would pick up is 10, the rate of change over 200 days. The same thing can be done for other. The utilities has the same thing, strong momentum across the board. If you go here on the ones that we looked at, the real estate, same thing. Everything is positive. So here, everything is positive. Here, what is it? Here, everything is positive. So what I do, I take the sectors that show positive momentum in relative strength, in the 200-day moving average, in the ETF moving average, the actual ETF, in the ETF rate of change. Those are positive, means yes, 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 yes. And then I take those that have the highest rate of change. Now, this is where choice, it depends how you want to play the game. Now, people who want to be aggressive would invest only in this because this is the highest rate of change and is likely to be the best performer over the next month. If you want to hedge a little the bet, you take others. What I do, I usually select the best 3 or 4, and then I put an equal amount of money at the end of the month in each one of them. The greatest risk to this model is your emotions. Sometimes, and it's happened to me as well, you hear things that so bearish, and the latest news or the Federal Reserve announcements or the famous gurus that try to convince you of bearish events, and you're tempted to cut in half your investments just to find out that by the end of the month you wish you didn't. So before you cut your investment or you move away from the model, think twice before doing something different from what the model is saying in the first place. This information is analyzed in detail in each issue of the Peter Duck portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.